domain is already mostly ruined. We can't see it yet, but we're going to start to see it happening. For all the previous tech shifts, whether it was in the cloud or the original internet bubble or whatever, they will all pale in comparison to what we're seeing now.
That's Burhan, head of UK at VC fund PT1.
Invest $500,000 to 4 million checks. Normally we lead rounds, and ultimately it's technology that is transforming the tangible real world around us. We can lead, that gives us an edge because in Europe most funds don't.
He breaks down their thesis and what they're looking for. Founders, take note.
It's a 1 in 250 chance to go from us looking at your deck to getting an investment. Fund 1 did about 20 investments and the conversion rate was slightly better in Fund 1, and that was 4,000 companies we looked at. Being smart is just the minimum hurdle. Is it an incremental change to a problem, or is it an actual change to a problem? If you're vertical in a market that's big but not big enough for them to care about, then you have more defensibility. Bottom-up market sizing is the best way to go for sure.
How has that changed everything you're looking at now? And what opportunities are opening up or exciting you?
Ultimately, the top tier founders actually care about that problem. And so they care about it, and that's why they're working so long, working so hard, working in a way where they're underpaid. They make it their life's mission to solve that issue.
So let's start off with what's PT1's thesis?
Yeah. So PT1, we're an early stage VC investing in hardware and software companies based in Europe. I don't like talking about stages because all the labels blur into one. So let's say we invest $500,000 to 4 million checks. Normally we lead rounds, and ultimately it's technology that is transforming the tangible real world around us. So infrastructure, industry, buildings, logistics, manufacturing, all of that jazz.
So everyone says that they're transforming the world, right?
Yeah.
How do you differentiate between who's actually worth backing and who isn't?
So I think the classic thing is it an incremental change to a problem, or is it an actual change to a problem, right? And so, okay, let's use an AI example, because obviously AI is hot right now. We've got a portfolio company that is using AI to generate renders for architects, which, and now why is this a 10x, right? Back in the day, you're an architectural firm, you're doing a bid to, say, win the tender to build the shard, and you're an architect, you're used to dealing with floor plans and CAD files and schematics, and you kind of can really visualize it. But the people who are backing you or who would fund you, they can't. They want to see a picture, ultimately, right? And that's what they can resonate with. What currently happens is you send your sketches to a consultancy, they'll charge you 30 grand, and in 4 weeks' time, you'll get a photorealistic render of, say, the shard, and that is what you would then use to win a bid. Great, right? It's a big, big business. People do it. Every single fancy building you've ever seen has gone through this process. AI can do that in 30 seconds, right? And so this is what I would call a 10x. It actually disrupts an industry as opposed to making an existing one better. In this example, making it better means you go from 4 weeks to 3.5 weeks, right? Irrelevant.
So you mentioned AI earlier there, right? And I think this is one of the interesting things of where it's a complete shift. But okay, let's say it's made it 30 seconds now rather than 4 weeks, whatever it was before.
Yep.
But can somebody else just do the same thing? How do you look at that defensibility when the technology is shifting so rapidly?
Yeah, so this is something which we're really discussing actively. And I think there's a few kind of differentiators and things to talk about. So if we zoom out, right, at a broader landscape view, AI has weakened defensibility for every single B2B SaaS startup. So if you're selling any kind of software, AI and companies like Lovable, etc., have made it very, very, very easy for a competitor to come out of the gate and do what you're doing. If we then pivot to talk about if your product is an AI product, so slightly different from the first example, the issue is that the foundational models, the OpenAIs, the Anthropics, the Mistrals, they can expand and kill your business because you're just a thin wrapper around them. If you kind of accept that as the status quo, then yeah, defensibility is a real issue. And then I think the things that we care about, one is how safe you are from OpenAI killing you, And for that, you have to go vertical, not horizontal. So if we imagine you've got your entire landscape here, right? If you're a horizontal wrapper around OpenAI, as GPT-5 comes out, you're probably dead, right? If you're vertical in a market that's big, but not big enough for them to care about, then you have more defensibility because, for example, there's an AI company that is replacing receptionists in US healthcare clinics, right? OpenAI will never make a specific product that does that. Their models might get better and better at doing it, but ultimately there are edge cases that they won't care about and someone can get value there. So that's like part of the answer. I can get much deeper, but you tell me. Like,
Go for it, go deeper.
okay, so that's like the product level view.
You made a promise now, you got to keep it.
Yes, sir. That's a product level view, which is fine, right? Then also, a lot of startups come down to execution. I can't remember who said it. Someone said to me recently that most startups die as a result of suicide, as opposed to killing them. Either they mess up, the founders burn out, they run out of cash, whatever. And so defensibility now is the founder execution matters far, far more than it used to. And it always mattered, right? It was never like a non-entity, but it's gone from, say, 70% to 90% because what you had remaining, which was your tech barrier, has gone weaker and weaker and weaker. And then there's other sort of things like switching costs and social proof and so on, which are relevant. But also when you're going this quickly, it's hard to get there soon enough. And so switching costs, obviously, like what is the cost to me to replace you with something else? And for some products, it's pretty minor. So like Zoom versus Google Meet, like the cost to us to switch doesn't really make a difference. But if it's, say, an enterprise ERP like Salesforce, it will take you 18 months if you're a big company. And so that's where you really can start to win out as well.
So looking at that, right? So you were saying about there's a step change in things happening at the moment.
Yeah.
And obviously you were at PT1 before AI became this whole new thing that is now. So how has that changed everything you're looking at now? And what opportunities are opening up or exciting you?
Yeah. So it's been really interesting because I think there's been a few transitions and like a few noticeable phases that we've gone through. And I mean, to give it context, so GPT-3 was the first open GPT beta that we could use that was on OpenAI's website, and that was like October 22. I was playing with a website that used GPT-2 in like sort of like January, February 22, so like the early beta, and it was rubbish. It was so bad. And so the jump from 2 to 3 was insane. And obviously when 3 came out, it went viral and it went sort of around the world really quickly. And that was great, but I think not many people realized then that it had value because 3 was still kind of crap. It was game changing, but it was hallucinating and it was confused and no context window and so on. And then the models got better and better and better, but also people started building tools around the models to help them get better as well. Like the first AI agents was like, I think someone was trying a thing called AutoGPT that was like, maybe like January 23, people were testing it out. And that was like a load of code trying to make a recursive GPT instance. And it was pretty bad. I was running it, but it was like people had the ideas to do stuff like this. And as we kind of like zoom out, right, I think phase 1 was, oh, this is really cool. It's kind of a gimmick, right? And phase 2 was, oh, I can now use this to help me write my emails and so on, right? And phase 3 was, I can now replace huge amounts of white collar labor with this. And then, but I think the final phase is now I can automate and replace. And so it's this final transition from, okay, I can make data extraction easy, and then I can give it out to somebody to type up, versus the AI can extract it, type it up, and do it all in one time, like single motion. Obviously, zooming out, like when I say AI in this context, I'm referring to an LLM. Like there's way more stuff beyond that, but like LLMs are like the key thing we're looking at right now.
And you mentioned earlier as well, so you invest not only in software, but also hardware.
Yep.
And that's quite rare because a lot of VCs don't really look at hardware, or at least a lot of hardware founders complain about VCs don't look at hardware.
Yeah.
So what makes you look at hardware too? and see the opportunity there when a lot of VCs won't touch it?
I think so. From the early days of the fund, right, we realized that we needed hardware. If we talk about transforming the real assets and like the built world, bits can only do so much, right? Some VCs love the phrase like bits and atoms, bits referring to software and atoms to hardware. I think it's quite a good way of putting it, right? Like if we think about construction is inefficient, slow, expensive, dying, so many issues in construction. Software can't really fix it, right? Like, doesn't matter how good you are at writing code, you still need to lay a brick. And so that's where hardware comes in. Or heck, like climate change, right? Biggest issue probably for our lifetime. What is software going to do? Like, you can't optimize your way to net zero. You have to actually build stuff. So I think we realized from the get-go that hardware was key to actually meaningfully move any of these sectors. As AI gets better and better and better, also hardware is key because you are harder. Yeah, it's more defensible, right? Like the software barrier, thanks to Lovable et al., is really thin. Hardware is still where you can have defensibility. And yeah, there are other issues around it, and it's slower and more complex and requires a different skill set to appraise and more capex intensive and so on. But I mean, the biggest private company right now is what? SpaceX, hardware company. If you look at sort of the big unicorn rounds this year, it's all things like Anduril, like defense rounds, quantum systems, etc. All hardware. Like software is great, but the biggest challenges we have are hardware.
When there's hardware founders who, because there's been a few in this podcast complain about venture capitalists and investors not looking at them because they're hardware.
Yeah.
What advice do you have for those hardware founders to get that money? Because like you said, the real deep tech stuff, right? That is going to have a market.
Yep.
But when you say like hardware that's maybe not as complicated, what can they do then?
There's a concept called TRL, so tech readiness level, and it's like how close you are to commercialize your tech. And TRL 9 means you're good to go, right? And basically, for a hardware founder, they'd have to diagnose their TRL very well, be honest about that, and then find the appropriate funding source at each stage of the journey. Because VC is good, but only at certain bits of the journey. And so if you're super early, you want grant funding and nothing else, right? You want R&D grant funding from a university or from Innovate UK, the EIC, whoever, to help you validate and de-risk your solution. If you're later on, like say TRL 6, 7, at that point, or even like 4, 5 maybe, at that point, VC funding could work for you. But then it's very much, what does the funding accomplish, right? And also, you need a legit CFO. A lot of really smart hardware founders come at this from like a pure scientist brain point or like an engineer brain point, which is fine. You need that to build it and sell it. But ultimately, how you win in this field is by raising money at the right time and the right price and the right cost of capital. And you have to understand how to do that, right? If I look up the hardware companies in our portfolio that are doing well, the ones that are growing the fastest have insanely good CFOs who understand, okay, and it's all like, to me, it's, you could say it's a bit boring, but like it's key, right? Like understanding, okay, where's Topco, where's Holding Co, who raises what money goes between what can I securitize, what don't I securitize, and so on. So like, that's the main thing. And it's, if you are a hardware founder and you want to build a unicorn or decacorn style company, make sure you have someone on your side who can actually like help you figure out your capital stack and get you from 0 to 10 products, site, facilities, whatever, without diluting too much. That's the edge.
So just looking at like, obviously you're going to get a lot of people coming towards you to wanting funding, right? How many pitches do you think you see a year, or how many decks are you receiving?
So I can't remember the exact number, but our conversion rate is a 1 in 250 chance to go from us looking at your deck to getting an investment. And so I think Fund 1 did about 20 investments, and the conversion rate was slightly better in Fund 1, and that was 4,000 companies we looked at. For Fund 2, we broadened our aperture, and so we're seeing more deals. And also, I think we've gotten like really strict on what we want to see. And so fund 2, the funnel is way tighter.
Oh, hello. Quick interruption to let you know a bit more about Bay HQ. We're the community for high growth Asian heritage entrepreneurs, operators, and investors in the UK. You can join us totally free at thebayhq.com/join. There you'll get our CEO structure in your inbox every week, which is content, events, and opportunities. You can also get access to our free Startup Fundamentals course by joining. Let's get back to the show. So can you go through the different stages of the funnel? So obviously, I guess some people, you don't even get their pitch deck, right? Because they just send a really crappy cold email and they don't even get to pitch deck phase.
Yep.
In that pitch deck, what do you want to see?
High level, like why now? Like why is it the right time to invest in your company? What unlocks it? What's changed? Market. A lot of people over-index on the market and do like really crappy TAM, TOM, SOM, like concentric circles, and it's all rubbish. But just make a compelling argument as to why this can make money, and also how much money can it make. And we call it bottom up, and it's really simple, right? Like if I know that someone is going to spend a tenner to buy an item from me, and they'll only buy it once in their lifetime, and there's 8 billion people, the market is 80 billion. It's that simple, right? Obviously, it gets more nuanced slightly, but bottom-up market sizing is the best way to go for sure, and that is how you do it. Like, don't do a McKinsey says this sector grows at 13% CAGR, like it's all rubbish. So market sizing for sure. Team is a big one. Like, why are you the right team to build this and deliver this? And a lot of people will over-index on, oh, I went to Cambridge and then I worked at Revolut, and I'm like, great, you're smart, but that's often like the standard, right? The benchmark is quite high, and so it's sometimes we care less about your credentials and more about like what unique insights have you got that means you've seen something that everyone else is missing. How do we know that you're going to do this journey for 15 years? Because it's not an easy journey, right? Figma, which obviously IPO'd last week, I think 13 years from idea to IPO. So and that's software. Hardware is even longer. It is slow. So lived experience, characteristics, like being smart is just like the minimum like hurdle, right? And I guess final thing, which loads of founders kind of miss, is why should I care about this problem and what you're actually solving? I think founders sometimes miss it because they're so heavily in the zone, they just forget that other people don't have that context. But like, why do I care about this? And if you're not solving a problem, like, why do I even want to invest?
So one thing I find interesting, right, is that at the pre-seed level,
Yep.
So obviously you said you don't invest necessarily in stages, but at the early days, if you don't have data, you don't have revenue, you're investing in the team, right?
Yep.
But in so many people, like you said, will put in their team slide just a bunch of logos, which doesn't tell me anything, right? So you mentioned Revolut. One example from the podcast is a guy called Rim Shah. So I don't know if you know him, but he worked at Revolut. He's gone through YC now, but he used to be the product lead for financial crime.
Yep.
At Revolut. He then built a company that's to do with financial crime. So it's a very clear, okay, I've worked at Revolut and I led this division, and now I'm building something related to it.
Yeah.
Whereas then somebody puts, ex-Google. So it's like, what? I think about 500,000 people have worked at Google in the last 20 years.
Yeah.
Like, what does that mean? What did you do at Google? And again, someone in the podcast, Satya Smith, so she used to be the director for the Google Maps part. So when she goes to build something, if she was leading Google Maps, she knows what she's talking about, right? And a lot of people just missed out. It's like collecting logos doesn't really make any sense. Say you went to Cambridge, right? Cool. What did you do at Cambridge? If you're now building, say, a deep tech company, were you head of the deep tech society at Cambridge? Like, what's the relevance? You've got to make each point and they're relevant.
Yeah.
And I feel like not enough people do that. I don't know what your experience is there.
Yeah, I think it does vary between sectors as well. So like, if I were a YC partner, I would, going through the applications, you would see just a million logos, right? And it's all be like Stanford and Berkeley, whatever. I think because YC attracts a lot of like 20-year-olds who want to start a company and have nothing else to do. So there's some variation, but generally, yeah, a bad team slide has logos with no context, and that's it. And also, like, the logo is nice, but like you said, you need to elaborate on why is it important, and also, like, is it actually that meaningful? Like in the example you gave, like, if you led a division at Google, that's insane. If you were a summer intern 4 years ago, doesn't have the same signaling power.
So obviously, let's say somebody's impression enough to get through the deck stage, right?
Yep.
What do you then do next? What's your next step that you have with the founders?
Yep. So high level, deck, first call, get to know them, try and understand the team, the ambition, the vision, so on. I will come back to this and we can zoom in on that, but say first call goes well, we'll discuss it internally among the investment team. People can raise red flags, questions, whatever. We'll kind of like talk about, do we back the thesis and so on. If it's still positive, we'll discuss it sort of with the full PT1 team. So have the partners come in and they'll be like, I like this, I don't like this, and so on. At that point, if one of the partners likes it, there'll be a full sort of team meeting. So all of the founders from the startup, the full PT1 investment team, there'll be like a 1 hour and 90-minute session where they present, we ask questions, try and take it apart, like debate, discuss, and so on. That's normally the last milestone before you write a term sheet. Obviously, in the background, there's emails and questions and calls and so on, but high level structure looks like that.
And you said the filter, as you said, about 250 to 1 at the moment.
Yeah.
Right? What percentage of that 250 will get to the first call and then to the investment team?
So if I were to like sketch our funnel out, it would be like that pretty much. So the first call, getting to first call, I think about half of the 250 make it that far.
Quite high.
Yeah. So like we, as a caveat, like we have like a top line of the funnel, which is where all the people who are sending bad emails, not relevant, don't care, they all get collected there. So if we're looking at your deck, it means that you're pre-vetted. So like serious, right sector, right geography. If you're a Chilean company doing a Series D in healthcare and you send us your deck, like, what the hell? So they don't get to that, like, call it like stage 0, right? So that means our jump from 1 to 2 can be quite healthy because all the trash and non-relevance has been removed. Then from first call to like internal meeting, I don't have the numbers off the top of my head, but from sort of memory, call it like 1 in 3 potentially. And then from there, it gets even tighter. So I think like if we discuss 10 deals in the investment team, the partners might see 2. And of that, 1 might get to an IC. And of that, like 1 in 3 might get an investment. So like it tightens up very, very quickly.
So in that first call, you're having them, right?
Yep.
Can you tell almost straight away whether or not they're going to get through to the next stage? Is it quite obvious quite quickly, or is it really down to the wire? Like at the end of the call, you're in 2 minds?
I think it depends. Like, I think I've done sort of hundreds, if not 1,000 or so of these first calls now. And so I've got not quite a radar, but I think like quite a good gut feeling just from the interactions and how they answer questions and how the founder relationships I can see and so on. Obviously, there's investors out there who've done even more of them, right? And I'm sure they've got like an even tighter like signaling process. Generally, you've got kind of like the business case merits, right? Which is when I ask them about the business case and what they're doing and the company and so on. But also you've got the founder traits and characteristics. And both of those are equally important for us to make a decision. If one of them is bad, we'll probably end the call there and then. Like, I've had some calls where after 5 minutes, I'm sorry, it's not a fit, and we just end it. Because you can tell.
I've met those people in person afterwards and just been like,
it's going to sound awful. I don't think so, but I do so many of them. I don't think I would know.
yeah.
But sometimes you can tell immediately. If the call extends, that's good. If I enjoy the conversation, I think the founder is engaged and switched on and interesting, and clearly they care about what they do. That's pretty much like an auto pass in the first call. Because bear in mind, to get to a first call, a lot of the basic stuff has passed already. Like, it's an interesting space. It's growing well. There's no obvious competitors. We think the founders, at least on paper, seem legitimate. So the first call is not calling it a vibe check makes it sound a bit too like insincere, but it is part of it.
Okay, so when you get into IC now, right?
Yep.
Obviously, when you're going to the partners, there's always this gap that I think is difficult for people to understand, right? Where they've had a call with you, and then you're going to the rest of the team, and you're fighting the case for them, right?
Yeah.
Because if you're presenting it to the team, then that's also your reputation, right?
Yeah.
It's like, okay, if you're bringing lots of bad deals to the table, then you're going to get judged by the rest of the team, and it's the boy who cried wolf, right?
Yeah.
So how do you go about that and that relationship? Because I think a lot of founders don't really appreciate that enough, that if somebody's putting you to IC, you've got to be really good friends with them because they're the ones who are putting their neck on the line for you too.
Yeah. Well, I wouldn't say it's about being friends with them, because I don't need to be friends with people who invest in. I think I would like to, because the relationship is like 15 years start to finish. And so it's important to be on good terms, right? But yeah, I don't need to, but I need to respect them. But yeah, so for example, whenever we have new analysts join, the one piece of advice I give them is, I would rather you bring no deals for 6 months than bring bad deals because you want to be noticed or you feel like you need your contribution to be seen. And so there's that internal kind of point of view, but also people work differently, right? Like one of my colleagues, he likes to bring deals which he's not sure of, but he likes. And so just to kind of like hear him about and discuss them internally, and a lot more of like a collegiate style discussion. Whereas I'm the opposite. I'm like, I will not bring it unless I want to give them my own money. If not, I don't want to discuss it. So there's some internal nuances, but generally, yeah, like if I am bringing a deal up to IC, I'm putting my name on it. It is my deal. I'll be the point of contact post-investment. I'm the one doing the portfolio stuff. I'm on the board if we're taking a board seat. Like I have to be convinced more than anyone else.
And you're talking about the board seats as well, right? How was that experience first time you did it? It's almost quite intimidating because obviously you've been through that process, but now you're on somebody's board and the responsibility that comes with that too, right? How do you manage that role?
I think first time round, it was the challenge of like, you're trying to be too helpful or you almost get in the way. And I think like the point is being no ego, just being there to listen, to ask stupid questions and reflect on what's being said. Like ultimately the board at an early stage is a strategic mechanism, and it's a useful way to reflect on last quarter, next quarter, and also to zoom out, because you'll get this, right? Like when you're heavily in the weeds, you're so focused on operational stuff and day to day, the big picture just like you forget about it, right? And so every day you're just cleaning out your inbox and you forget what like the long-term goal actually is. And the board is a helpful way just to reflect, zoom out, and discuss that and reframe it. And so I think what we kind of realize is like, we are not the subject matter experts. If I'm investing in a company and I know more than the founder, it's a bad investment, like 100%. They need to be the experts, and we're just there to provide a reflective mechanism.
And on that point as well, so looking at the value add now, right, is that for the hottest startups, I think a lot of people don't realize this enough too, is that they get a pick of investors, right? And it's almost the flip, right? Is that for the companies which aren't clear, which haven't got good stories, if they are good companies, if they can't get the message across, they're chasing investors.
Yep.
But the ones who really have good pitch decks, are able to articulate themselves well, can show a clear way they can make money for investors, then investors are fighting for them.
Yeah.
And how do you try and win those deals as well, right? Because that's part of your job, is not just people pitching you, but almost you pitching them to be like, you should take us on as a partner.
Yeah. So it's something which we often discuss internally, is to like, how do we win the best founders? And different funds have different approaches, right? If I were a mega fund, I am valuation sensitive, so I can just write a bigger check. We don't want to do that. I don't think the maths of that works out. I think there's TVPI implications, and I think that's not the approach we're going to go down. For us, it's offering help and advice when needed. I think being a sector-specific fund has its merits. One, because we do get the space to some extent. And so if you are a generalist investor and you're on 8 different boards in 8 different sectors, you will have to like context switch and you will ask the same question every time in a board meeting. Like, remind me, what's this market about? We don't have any of that, which is, I think founders sort of care about it to some extent. Also, I think many times we are competing for deals, but before I joined VC, when I was at a startup, I was under the impression that like one investment meant one investor. And in reality, like, there's a lot more nuance, right? And you may have like 6 investors doing one investment together. And so I think we try and take a collaborative style and say, hey, look, we would like to lead, but we can do half the lead. You come in, co-lead with us, and then we'll make room for like these 3 followers because we think they're legit. And so there is some like flexibility there. And also because we can lead, that gives us an edge, because in Europe, most funds don't. It makes it a bit easier as well.
So looking at your own personal experience as well, right, is that I'm a founder and you're thinking you're going to lead the round, right?
Yep.
What is it that you think like you bring to the table in terms of like, the sector background too? Like how does that fit into things? Like what are you bringing, or makes someone want to work with you?
Again, like when I sell myself to founders, well, I don't actually sell myself, right? But I think the impression I put forward is that, yes, I work in a startup, so I can empathize, but I'm not there to say, oh, we did this, therefore you must do that, right? All of that lived experience, I just discount as irrelevant, old, archaic, whatever. I think empathy is a big thing. One is just being able to get shit done, frankly. Like, and I think founders respect that because their entire job is getting shit done. There have been some times where like you want to get a board meeting in and you ask an investor and they ask their PA and 2 weeks later you've still not got a board meeting in. No one likes that, right? So I think it's just like, be helpful, try and have no ego. Like I try and be humble and just say, hey, I know nothing. I'm just here to kind of like reflect and observe and advise if I can. If not, no stress. And also like knowing the balance of like when to come in and when to back off. No one wants like an overbearing investor who texts them every day and saying, hey, what's your revenue looking like? No, nobody needs that, right? And so summary, like, don't be a dick. But that's quite a hard skill in this field sometimes.
So looking at the sector side as well, right? So you're talking about how by being sector specific, it means you understand the nuances of that industry, means that founders are more likely to, I guess, get less frustrated with you, right? Where somebody who's more generalist, I just said, they might be asking the same questions. There might be things that they didn't quite understand. So for people in your sector, what are some of the nuances? Like what are some of the ways that by you working that sector over time, you're looking at things in a different lens and a generalist investor might?
Yeah. Well, I think the sectors we look at are pretty old school, right? I mean, let's talk about construction, which is something that we invest in. We think it's super interesting. I spoke to a global construction company, billions plus in revenue. They've done projects that you'd have heard of. And I spoke to one of the innovation teams about like how they innovate and work with startups. And we were speaking about a startup that they loved. And this company had sort of like about 100 global projects live at any one time, of like sites live, right? And they were testing this startup on 3 out of 100. And I was like, okay, great. Like, you love it. You said you love it. When are you rolling it out to all of them? And they said in 6 years. And I was like, what the hell? Right? But it's stuff like this, right? People, I think if you are a construction tech founder and you know you are selling to an industry that is very different and archaic and old school, what you don't want is like an investor on your shoulder who just doesn't appreciate that and is like, why can't you do it? We've got a company where they are selling to people in construction, and it's quite funny. Sometimes their potential customers just forget to come to Zoom calls because they just don't use Zoom. They don't have an Outlook diary, right? Because they're always on site. It's not a concept for them. And so and they spent like a month where they would book all of these calls and no one turned up. And not out of malice, it's just like, it doesn't work that way, right? And again, if you're, there's a lot of these like industry specific nuances that people will miss. So yeah.
For people building in like these boring industries, what advice do you have for them?
Yep. So biggest one, and like the core rule here is, I would never invest in someone who picked an industry for bants. Like, only ultimately the top tier founders actually care about that problem, right? And so they care about it, and that's why they're working so long, working so hard, working in a way where they're underpaid, and they make it their life's mission to solve that issue. So that's like a base kind of rule. But now let's say someone has worked in construction before and they're like, this is shit, I hate it, I need to fix it. And then they really want to solve it. I think advice is one, like, great. The industries that are trickier to break into have way more value to extract. Sort of be like, no one else is doing it. And so you have way, way, way more control. And C, the industries that are more old school and typically more broken are also way, way, way more network based, typically. And so by already having a network and market not context and knowing the lingo, you are way above any other founder who, again, sees a McKinsey report about construction productivity being stagnant and thinks, oh, I can fix it. So like, happy days. Don't be inspired, go out and do it. Message me online.
So you mentioned the McKinsey reports, right?
Yeah.
So you do your own reports too, right?
Yeah.
So obviously they're not like the McKinsey reports, they're in detail and in depth, right? But how do you keep, like, what's the PT1 doing to make sure you're cutting edge in that research phase?
Yeah. So I think a lot of it, this is going to maybe sound a bit trite, but a lot of it is just like actually thinking about things.
It always helps to think, but it's hard though. Thinking is hard.
Thinking is hard, right? And so right now we're doing a report on robotics. We'll publicly launch it in a month's time. We've got like an early access copy out now to some friends, and this has been the culmination of months and months of work. And because A, it's a complex space that's changing every day. B, the big consultancies don't have a view because it's so small. Like, they may have a general view on robotics and productivity, right? Fine. And that's a huge market. But the subsets, which are still like billion plus markets, they just don't really care about because it's not worth their while. This is going deep into it, right? It's speaking to the stakeholders, understanding the value chain, understanding the capital flows, understanding sort of where the money comes from. And by doing that, so we've spoken to startups, to our network, i.e. LPs in the space, people who are working there, have tried to build there, other VCs who like the space as well, just to make sure that we understand what's going on. And the final thing, right, is like, you have to have an opinion. You can be very good at analyzing data, but ultimately the point of analysis is to make a decision. And so for our robotics sort of like view, we're making the claim that the market will converge into two separate camps. One camp is what we call the outcome providers. They actually do stuff like laying bricks. The other camp are providing the rails and the infrastructure. They would make, for example, software that connects from a building model to site with LiDAR or something else, and, you know, like betting the building blocks. And the bet which we're making is that the outcomes camps will become unicorns quickly, but they'll never get to that same scale as the rails camps, but they will have a way harder journey, and that will be a way more cutthroat journey.
So fun fact of the day, not that fun, but Tech Nation in the last report, robotics is the fastest growing industry in the UK.
Yeah.
By far. So it's interesting, like you said, where it maybe doesn't get as much press as some other industries, but it went from, I think, 100 million raised 5 years ago, 10 years ago, to now well over 1 billion. So it's like accelerating quite quickly there.
Yeah.
And the reason I'm reading the reports, because we're doing our own report too. So what obviously you do is you read everybody else's reports to work out what does a good report look like.
Yeah.
Just before we go to quick fire questions, is there anything else with the industry that you think is really exciting right now that people should be thinking about or paying attention to?
Look, like right now, obviously, climate is the overarching theme, right? We've gone past 1.5. the planet is already mostly ruined. We can't see it yet, but we're going to start to see it happening. Also, we've got inflation, labor costs are going up, the economy is stagnating, or still growing, but not as well. I think like there's a lot of negative stuff we see, right? But as a result of that, now is the perfect time to innovate in complex sectors. Robotics can finally do stuff in construction, which is like a huge milestone, right? AI is insane. It's getting better every day. There'll be huge labor transitions from like AI automation. Now is the time to build and be excited about what we can build, right? I think if we look at all the previous tech shifts, whether it was the cloud or the original like internet bubble or whatever, like they will all pale in comparison to what we're seeing now. So like build stuff.
I'm glad there's a but there because like everyone's fucked.
Yep.
This is the end of the world.
Yep.
But build stuff.
Build stuff.
Yeah.
Yeah. Fix it.
Yeah. That's the thing, I guess. Entrepreneurship is all about problems, right?
Yeah.
And right now there's a lot of problems to try and fix. So
yeah,
you're spoiled for choice of things to build.
Yeah. And like people will funnel trillions into these problems, right? And I think it's a fallacy that the state and large corporations are the ones to resolve them. Startups will play a big role, and we're all here for it. Like, pick a complex problem, build something, and you'll do well. Look at SpaceX again. Like, okay, Elon Musk issues aside, which is a separate conversation. Like, SpaceX is like, the concept is kind of insane, right? But if you look at the graph of like number of space launches over time, SpaceX is doing this, and that's all down to SpaceX, right? And that's a problem which who would have thought like private capital and individuals can fix.
So going to quick fire questions now then.
Yep.
So first one, who are 3 Asians in Britain you think are doing incredible work and you'd love to shout them out?
Yep. So shout out to 2 of my portfolio founders. So Lucky Ahmed, CEO, co-founder of Climate X. They're building climate risk analysis software for banks, but really complex stuff. Startups killing it, growing really well, and I think will do insanely well in a space that matters. Another founder, Johnny Su, CEO, co-founder of Ask Vinny. They're a agentic AI content management platform. Still under a year old. Number of units is growing every week, and there's a real chance in a year's time they are one of the biggest property managers in the world in terms of like properties they manage, just from the rate at which they're growing. And then finally, Ibrahim Farulo, sort of someone I've worked with for 8 years now, doing some great stuff like running Menchu. He's a senior in another startup as well, and doing lots of like general stuff type of community.
Awesome. And if people want to find out about you and PT1, where do they go to?
PT1 website is nice and easy, pt1.vc. Sadly, LinkedIn is my main platform, which is a shame because LinkedIn sucks, but you'll find me on LinkedIn. Just search PT1 and I'll be there. You'll see me with a turtleneck looking very visionary, as all tech bros do.
And is there any way that the audience could help you today?
If you're building stuff, come find me. If you disagree with anything I've said, perfect. I love discussing. So like, come find me, call me wrong. I'll buy you a coffee. We can get into it. Like, no issues there. And yeah, and also just if there are any founders who have worked in the built world and want to do stuff or they're afraid to take that step, drop me a message. We do pre-seed. Happy to talk to you, help you figure out if it's worth solving, and we can take it from there.
Thank you for watching. Don't forget to subscribe. See you next time.